the benefit it provides your overall portfolio to be able to act as a true source of diversification when you've got really stressed, markets and traditional assets. That's an important feature to look for in an alternative, not just how it does in normal times, but how it does in extreme periods as well.
Welcome back to the Stay Invested podcast. I'm your host, Dave Townsend. Today I'm joined by Phil Huber of Savant Wealth Management. Phil, thanks for coming in.
Thanks for having me. Great to be here.
Hey, so we're going to talk about the Allocator's Ad Share, your new book. I've read it. Being a nerd of finance, I thought it was a wonderful book, written from a practitioner's point of view, but for the wonkier types like a CIO, they could get something out of it too. But before we dive into the book, Phil, can you give us a little bit of your background?
Sure. So I'm the Chief Investment Officer for Savant Wealth Management. We're a registered investment advisor, independent fiduciary, based out of Rockford, Illinois, but with an expanding footprint across the Midwest and other states. We've been growing, quite a bit in recent years, and so we've got, I believe, it's now 24 or so office locations in 8 states. I joined the firm about 2.5 years ago through a merger with my prior RIA, which was Huber Financial Advisors, and I spent about 12, 13 years there before we joined Savant. So really my role, is to help lead our investment team, which I have a director of research and a handful of analysts that ultimately does all the research and due diligence for the firm. And then I also co-chair our investment committee that ultimately makes decisions on the types of investments we approve for clients at Savant, as well as the model portfolios that we use and things like that.
Yeah, nice. Well, I got a secret for you, or I got to let the cat out of the bag. I've been hearing about you for about what seems 15 years now. So this is actually the first time we've met. So this is not quite a bucket list, but it's certainly been a long time coming. It just, when you were with Huber, now obviously Savant, so many good things I had heard. Matt Krall, does it ring a bell? Matt Krall. Yep. He'd always tell me, look, I gotta introduce you to Phil Huber. You guys were moving and shaking, and so I've been hearing nothing but good things about you ever since. For quite some time now, so it's finally nice to finally meet you formally. So.
No, it's a pleasure. Yeah.
So let's get into the book here. So look, right off the bat, any book with a foreword by Cliff Asness has me at hello. So just a wonderful book. Again, it is written from a practitioner's point of view, but it has the heft to the more wonkier type of financial allocator, investor, advisor. There's a little bit something here for everyone. You come out and say it right away. I don't know. I'm not sure I've ever heard anybody say that they've enjoyed asset allocation from almost seeming like since a young age. So, let's just dive into the asset allocation conundrum today. Like, where do you see things going? Why is the book? And so for those who haven't read the book yet, diversification and using alternatives as something as an alternative to, say, the usual conventional stocks and bonds, we've been something on easy street when it comes to allocation, in my opinion, for some time now, especially after a record bull market. Why do you think asset allocation may come back in style, if you will, where maybe it's been to the back burner more recently?
Sure. So, from a very young age, even before getting into the business, I had this just weird fascination with asset allocation. To me, it was a little bit like a puzzle. Like, how do you combine these different things together to form different types of outputs based on the underlying ingredients and the recipes that you use? I think a lot of that probably stemmed from growing up with a father who was a financial advisor, still is a financial advisor. That was the Huber and Huber Financial we mentioned earlier. That was him founding that firm back in the late 80s, and I joined in 2008. But, growing up around the business, understanding that what he did for his career was not he wasn't picking stocks for clients. That was not the value that he brought to the table. It was the financial planning work he did for them, and then the portfolio was in service of those plans. And so really the ultimate long-term driver for these financial plans that are going to last 20, 30, 40 potentially years and beyond, the asset allocation decision is going to be the most important decision, not whether you were, in this stock or that stock, or if you tried, timing your ins and outs to the market. It was really about thoughtful portfolio design and trying to align the portfolio's risk and return characteristics with the ultimate goals and objectives and constraints and preferences of the end investor that we were working with. So that I think I probably came at it from a different angle than most people who come into investing, who maybe kind of learned some early lessons the hard way about how challenging it is to pick stocks or time the market. Those were just things that were kind of not beaten out of me, but just that I just never really actively did as a younger investor, because it was kind of sitting at the learning tree early on, and from my dad, I just learned those longer term weren't going to be the things that added value. So. And so I became fascinated with that. I think everyone, understands the traditional stock bond type portfolios, whether you implement through individual securities or mutual funds or ETFs, this idea of having these sort of two levers you can pull, stocks for growth and offense, bonds for income and defense. And that, has worked quite well for many years. And a lot of that, being on the sort of tailwinds of a secular, decline in interest rates that, really made that a satisfying and easy to implement type of portfolio. So very understandable why that sort of became the default type of approach for many allocators. And it doesn't we use 60-40 as kind of the shorthand for that. It doesn't have to be 60-40. It could be 50-50, 70-30. Sure. But just this idea of having those two, kind of two dimensions, and then, increasing or decreasing them based on return targets or risk tolerance or things of that nature. And so as time went on, it was a couple of things were becoming more and more clear as I learned more about investing, and that became more of a focused part of my role. That was where my passion and interest was leading the investment efforts at our prior organization, and now at Savant, was understanding what are the tools that we have at our disposal, and that opportunity set is continually evolving. And then what is the return outlook, not in the short term, because that's all very noisy, but just as we look longer term, 5, 10, 15 years out, what should our kind of anchor be in terms of what we can expect out of stocks and bonds. And that was becoming more and more troubling in the kind of mid to late 2010s, rates continuing to decline and get to pretty historically low levels, and then equity valuations, particularly those in U.S. large cap stocks, continuing to kind of march upward. And we know that valuation is not a great timing tool, but we know it does have a decent amount of information on expected returns over intermediate and long-term periods of time. And so that presented some uphill challenges for those 60-40 type allocations, where you probably have to ratchet down your equity allocation or equity market expectations. And then similarly, in particular, it's probably more straightforward in bonds, is that your starting yield is a fairly good approximation for your expected returns. So you had this expected return challenge where to achieve the same expected return that maybe you could have done with 100% bonds 20 years prior, you now needed to take an increasingly large amount of risk to achieve that same return target. And similarly, we were operating in a very benign inflation environment for many years, many decades. I had never, even in my own life and career, never experienced up until now a period of high and rising inflation to the degree that we're seeing today. And so we know from our relatively limited historical analogs to that is that can be very detrimental to both stocks and bonds. And so this relationship that we grew kind of accustomed to of, stocks down, bonds sort of flat or slightly up, that gets really challenging when inflation is high and there's this need to restrict financial conditions and raise rates, which can again, that kind of short-term risk-free rate is going to be the gravity around the rest, all of financial assets. And so it kind of brings everything down. And so that's, we're witnessing that firsthand in 2022. It's been one of the worst years for 60-40 type portfolios on record. And in particularly for that 40 piece of the bonds, I don't think anyone in their right mind would have expected a 15+% drawdown in core fixed income. It's been quite surprising and very, I think, upsetting to people to count it on that piece of their portfolio for ballast and defense. And so the expected return, part of it is one part of the equation. The other was just looking around, we saw like there was this evolution of alternative investments from being, things that have typically been the domain of large institutional investors or maybe family offices or really ultra high net worth, and some of those strategies, not all, coming a bit more downstream to your average high net worth investor. It started with liquid alternatives, which, again, kind of a big proliferation of products following the global financial crisis. There were a handful before, but all the interest came, after the portfolios blew up, and then everybody was looking for protection at exactly the time they should have been, adding to risk assets, and that tends to be very commonplace where people start looking for the thing they should have been doing, ahead of time, and so I think that was led to a lot of disappointment with liquid alternatives initially, where some quality strategies and managers, just bad timing and maybe improper expectations, where great in theory, but then when you got a big bull market in equities and you have maybe too high of expectations on what your liquid alts should be delivering and that they should be some kind of silver bullet that delivers positive returns in all market environments, I think there was a little bit of a rude awakening to many advisors and allocators that, okay, these things can be valuable, but you got to hang on to them long enough to experience those benefits, and they're not, you got to understand the risks involved too. They are going to, like any investment, go through ebbs and flows. So there was the liquid side, which again kind of had a big pop, and I think interest kind of faded for a while, and now is starting to see a resurgence. And I think that there is some good quality strategies that you can implement in liquid ETFs or mutual funds. Alongside that, and this is probably more of a recent trend, has been this kind of growth of what I call semi-liquid alternative investment structures. And so I think, people often think of liquidity as sort of a binary, like you have daily liquid mutual funds and ETFs, and then you've got the other end of the spectrum, which is your, drawdown private equity type vehicles that are for qualified purchasers only, high minimums, long-term, call it 10 to 12 year, lockup periods, and K1, so complicated tax reporting. So just a lot of different features and operational complexities that perhaps your average investor or advisor either isn't familiar with or just doesn't, necessarily view the benefit being there for all the additional, complexity and work involved in making those. So what we're seeing now is sort of a middle ground of different types of registered funds that have periodic liquidity, limited sell liquidity, so you kind of open up the door to less liquid alternatives that you probably couldn't do inside of a daily liquid mutual fund or ETF, but with some of the same features and comforts that investors have come to love from those regulated products of just 1099 tax reporting, reasonable minimums, either no investor accreditation requirement, or at the very least maybe accredited investor, which applies to more people than qualified purchaser. And so you see things like interval funds, tender offer funds, private REITs, private BDCs. And so, areas like real asset and real estate on the private side, private credit, insurance-linked securities, just a handful of asset classes that you can kind of expand the opportunity set to include with some of those. And so it was kind of these sort of parallel evolutions that were happening that really sparked this passion and interest to explore the deep and wide world of alternatives, to really just ultimately try to build better portfolios for our clients, give more confidence around delivering those outcomes that they're hoping for, and be less reliant on what's worked in the past, knowing that regimes can change, the forward-looking expectations can change, and we want to not just be too complacent with what portfolios looked like, knowing that those are constantly going to evolve. And we just have to look at things like the ETF, for example. The first ETF came around, I think, 1993, Spider SPY. That was, not that long ago in the grand scheme of things. And now you've got trillions of dollars in ETFs and, very much the default choice for many in terms of pooled investment vehicles. And so it just goes to show you the way, the objectives we have in building portfolios, like reasonable return, wanting to manage risk and diversify, all those remain the same. It's just that the tools that we implement those with are going to evolve and change over time. So we need to be ready to adapt as advisors and allocators.
Yeah, adapt. That's interesting. We did a campaign last year we called Beyond Markowitz. So Harry Markowitz, Modern Portfolio Theory, and it was not it wasn't your classic critique takedown. The assumptions are all outdated. All that. It was more standing on the shoulders of giants to say that, just as I describe it, you had mentioned 60-40, whatever your stylized generic portfolio it is. To me, it's that there's, like everything else, there's a supply chain challenges, right, in terms of where the return is going to come from, right? So said a different ways is just looking ahead. Most capital markets expectations for your vanilla stocks and bonds is going to be problematic and muted at best, right? So you had mentioned liquidity. I'm curious, have you guys done anything in terms of like trying to take advantage of a liquidity premium? I just think that we oftentimes there's a certain amount of structural inefficiency to say that your portfolio is purely in ETFs or mutual funds or even single name stocks, bonds, securities that have a constant bid, right? Most people just don't need that level of liquidity in their portfolio. Now, everybody's different. Some people might take comfort in that, but there is a level of inefficiency to say your portfolio is like ridiculously over liquid because most people aren't going to sell down or draw down that much on it, at any given moment. So have you started to? You had mentioned private assets, private credit, and other asset classes, especially in the alt space. The liquidity premium, do you see that as a potential source of like alpha or an edge moving ahead?
Great question. Yeah. So I think first and foremost is that most investors, particularly affluent investors, don't necessarily need 100% daily liquidity for their entire portfolio. And I think that has historically been a default assumption for many. I think that's starting to change and will continue to change where, I think most, clients will have some sort of budget for somewhat less liquid investments. It doesn't have to be, again, 10-year lockup type funds. It could be, things more in that kind of middle area of semi-liquid structures. But I would say it's less about this like assumption around a constant illiquidity premium because I think there's conflicting research on the presence of illiquidity premium, and maybe it varies by whether you're looking at private equity or private real estate or private credit, et cetera. And it's not, even the existence of one doesn't mean it can't be, it can't disappear if fees are too high, because that's another, big gap between public market investments and private is that you have got fees. So you can make an argument that if there is a illiquidity premium, that by and large the manager might be earning most of it.
Sure.
But and then interestingly enough, Cliff Asness, who wrote the foreword for the book, he's written a lot and talked about a lot lately of this idea that almost the inverse of that there might be a illiquidity discount of sorts, where if you think about the experience of being a public markets investor, it can be challenging. Volatility is uncomfortable for a lot of people. And so there's almost the argument if you assume the same long-term return for public versus private, if that long-term experience is a little bit smoother, then that's more of a behavioral benefit. And then you would argue that maybe people should pay a premium for illiquid investments because they don't have to worry about or deal with the day-to-day volatility. So I think you can make arguments in both directions. I think there is a diversification benefit to some private market asset classes. I think there's also the risk that people understate the risk inherent in them because they don't mark to market every day. People maybe assume they're less risky or less volatile than they truly are because of that limited marking to market. And so I think there's a balanced, nuanced argument, but I think there's potential benefits to including a subset of private market asset classes in a diversified portfolio for clients that can understand the risks involved, be comfortable with that illiquidity, and again, size that illiquidity budget properly in the context of their financial plan, any potential known or unforeseen liquidity needs they might have or income needs. And so the last thing you want is someone who needs all their half their money freed up and they can't do all that immediately because they're some of it's tied up. So I think that's a conversation that advisors need to start having more and more with clients, is understanding what their ability is to take on illiquidity risk, and then if there is that budget, figuring out what types of investments might work within the confines of that.
Yeah, I thought one of the more clever bits to the book was that you introduced the periodic table of assets, right? And so we have like Callan's chart. There's a handful out there that are those key charts, if you will. What I thought was interesting about it, and I don't know that you said it specifically in the book, but I thought almost it was like almost a challenge or a call to arms for financial professionals to just get more creative in portfolio construction, to say that maybe it's time we come off of, and I believe the way you described it was obviously status quo or inertia, to like just continually doing things the way we've done. But through technology, innovation, and so forth, that by treating these assets as like part of the periodic table, by recombining these elements, you can make something stronger. And it made me think of a piece by Chris Cole. You familiar with Chris Cole?
Artemis?
He's Artemis,
Yeah.
exactly. And I remember a short piece he did, it was a few years ago now, where he was, it's easy to get hung up on all the numbers and quantitative stuff. And the piece he was talking about was Dennis Rodman. So obviously the famous Chicago Bull, the worm, right? And he was saying, if you looked at Dennis Rodman on paper, right, he wasn't a great forward, right? On paper, he didn't statistically, other than the rebounds, right? He didn't score a lot.
Right.
It was so statistically or quantitatively, if you looked at the metrics and given that, like everything today is big data oriented, Dennis Rodman you wouldn't be picking Dennis Rodman based on the numbers, but when he was on the court, you could quantitatively demonstrate how much better the Bulls were and how he elevated everyone around him. And so coming back to that periodic table, I just thought it was interesting to view these asset classes as something of an ingredients to, frankly, just getting more creative. And I know it's not the first time to say, investment management is part art, part science. Was there any little bit of a challenge there to the financial community to just start thinking out of the box and just getting more creative?
I think it's great to have analogies because it helps make it more relatable to end investors that maybe aren't CFA types. I'll get back to the periodic table in a moment, but like some of the sports analogies too are perfect because a lot of sports fans out there, and the Dennis Rodman example is perfect in that again, if you're just looking at the number of points that he's putting up, then you might say, hey, this is not a valuable contributor to a team. But no one in their right mind would argue that Dennis Rodman was not a valuable contributor to that Bulls dynasty for the handful of championships that they won.
He's
with
a diplomat
him.
too, so.
So I think it's the same as a portfolio. We tend to often think too heavily about the individual line items and examine them as opposed to examining them in relation to the other things in the portfolio and how they complement them. And so you can use football too as an example. Like there's always the saying like defense wins championships, and that applies to other sports as well. A great football team is going to have a great a great offense, a great defense, and even a great special teams. Like you need all those pieces working in concert with each other. And so I think that was often how people maybe misused alternatives. They expected too much out of them. They expected them to be the offense, the defense, and the special teams. And it's like, no, you got your stocks are there for your growth. They're the ones putting up the points long term. Yeah. But they might not be the ones grabbing up rebounds or making steals and doing all those other even intangible types of things out there in the portfolio. And so I thought sports there's a number of good sports analogies to think about when thinking about asset allocation and portfolio construction. But I've always felt that the periodic table of elements was a natural fit for a couple of reasons. And so I had actually built that table as just a visual aid even before the book. That was a few years back. It was a natural fit to include in the book, but it was something I had been thinking about for a while of like, how do we decompose the investable universe into all its kind of basic components? Yeah. And then also assign to them. You'll notice like each box in the table, there's a little letters in the top left and right corners of each box that are associated with on the key. There's a number of what I would call just kind of basic either primary or secondary objectives you have for any investment. Whether it's capital appreciation or income or inflation sensitivity or downside protection, liquidity premium of sorts. Those are all, tax efficiency being another one. Those are some of your basic objectives and goals of an investment. Mm-hmm. And then it's about this idea of a periodic table. Again, if you take different chemical elements and combine them together in different ratios or proportions, your corresponding compound is going to be different. And the same is with a portfolio. If you start mixing and matching these different investment elements, you're going to get different results. And so it kind of brings you back to this like first principles, like what are we trying to achieve for the client, and how do we use this large universe in front of us to best select the things that can help us deliver that desired outcome. The other thing that I thought was interesting about the periodic table is just reinforcing the idea of continuous evolution and not staying complacent or stagnant with current thinking. And that I did a little research and just kind of like, when were all these different chemical elements discovered? I think there's 116 or so and counting right now. I might be a tad off on the number, but then I looked.
We won't question.
Yeah. But it was like, when were these discovered? And you just see like century by century. It was like, okay, initially there was like 16, and then 30, and then 50, and it was like, these weren't all discovered at the same time.
Yeah.
You know, it took a lot of scientific work and effort to continue to discover new elements and you know, expand that chemical periodic table over time. And so the same has happened in investing as investors as a whole have gotten smarter, and we've leaned on the world of academia for kind of better understanding and dissecting the drivers of risk and return, and then just this kind of continuous democratization that has made things more transparent and easier to implement, and fees have come down in many areas as well over time. So just again, it net benefits to the end investor that just make things a little bit more accessible. So all those, I think, made it a perfect analogy for what we're doing here.
Yeah, I remember coming up. It used to be, well, hedge funds is obviously the classic alternative investment, and certainly there's a million different types now. But it used to be the case where, like, when hedge funds was the core alternative investment, it was kind of sexy, like cocktail parties or whatever. Say, who's managing your money? You'd be, a hedge fund, or something like that. It was kind of a cool and sexy product. Well, it's obviously 20 years ago. I thought it was interesting in the book you mentioned a lot of investors, clients, the financial community talks about alternative investments, and they conceptually get it. And most people you would ask would agree, oh yeah, they're appropriate and they're important. But in practice, they're far fewer allocated to the level of, if you took a temperature, you would think that portfolios were stuffed far more with these. And you'd mentioned the education gap as perhaps maybe part of that reason, where conceptually people agree they are appropriate, but in practice the allocations are far thinner than what may be recommended. For the education gap, how do you think we start to close that? Like, where can we begin to start to close that gap, to get more people more comfortable with these things? Because you had mentioned also in the book that, like, part of it is just getting comfortable with maybe doing something that's more unfamiliar, right? And so you have to kind of get comfortable with this. And as financial educators, communicators, so forth, we have to do a better job of elevating the level of education around here. Where do you think that we could begin to do that?
I think there's on one hand, it's a proactive approach to setting expectations, because if you're not going to set reasonable ones for your clients, they're going to very much likely set unreasonable ones themselves. And the hedge fund example is a good one, where that just the way people use hedge funds out there, like in the institutional world, et cetera, has changed quite a bit over the last 20, 30 years. I think in the early days of that industry, there was not the tens of thousands of funds that are out there today. It was a smaller number of managers, and alpha was more plentiful. And that's changed quite a bit. And there's a lot more competition now. Alpha is more scarce, where I think it used to be this expectation of like better than equity returns and like bond-like volatility. And that's certainly changed. And then you've got this proliferation of all these different types of hedge funds. And what a macro fund is trying to do is very much different than what a fundamental long-short equity manager is trying to do. And so I think lumping all these together is also a challenge, because they're all trying to do different things. And then when you look at them sort of as a whole, I think it surprises people that the kind of hedge fund industry, market beta is typically fallen between like 0.3, 0.4 beta to equity markets, maybe, similar levels of beta to like high yield credit. And so despite having hedge in the name and hedge fund, many hedge funds are very much not hedged, and I think surprise people in terms of how much actual downside there might be embedded in them. And so I think there's been this kind of evolution of alpha into beta over time. I think the early pioneers deserve a ton of credit for discovering those things that are now considered alternative betas, because no one else was doing them, and they were smart enough to conjure up these different types of risk premiums over time. Like an example being like Ed Thorpe, this kind of discovering and inventing convertible bond arbitrage. No one else was doing it at the time. That was alpha. Now there's tons of dedicated convertible bond arbitrage, managers and specialists, and it's so expectations have to come down because you've eroded some of that alpha, but you're kind of left with a systematic beta component or risk premium, but that's changed over time. And then expectations, I think in general, this is more relative to advisors and individual investors they work with, is there is a huge gap. There's a study I reference in the book from Natixis that they do every year. So the 2021 one being the most recent, I think, that was out, and the results are pretty much the same every year, where they survey professional investors or advisors in a number of different countries and individual investors, and just ask them, what are your long-term expectations above inflation for what you should get out of your portfolio? They don't specify what kind of portfolio; they just kind of keep it very vague and general.
Okay.
But what's very noticeable is this gap you could drive a truck through between what advisors expect, usually kind of mid to high single digits, and what individual investors expect. And again, this after inflation, the results were like the mid to high teens. And so people that don't have a natural understanding of the history of markets and what do stocks deliver long term. I think maybe they're going based off what their portfolio did the last calendar year. Maybe it was a really good year, and they're just saying, okay, well, if I earned 20% last year, I'll get 20% every year. And so I think that doesn't even get into alternatives. That's just like very, very basic, like individual investor versus professional expectations, and that you got to find a way to bridge that gap. So just being more proactive and thoughtful and sitting down with clients and letting them know, here's what we reasonably expect long term from these different asset classes, from the portfolio as a whole. That's not going to be in a straight line. Here's some of the variability we might expect out of that, and potential downside, and just kind of walking them through that. So I think that's one piece of it. And I think the other part of your question was like, how do you take these inherently more complex and unfamiliar alternatives and make them a bit more, familiar to people, and less, complex, is just drawing parallels and maybe connecting the dots between things they already own and some of the things that they might view as alternative. And so we can look at a handful of examples. Like an easy one would be, private equity. It's just equity. It just happens to be illiquid, and it doesn't trade on an exchange. But it's not like an alternative per se that has some uncorrelated return profile. It's just companies that are making money, and you're hoping to participate in that earning stream as an investor or an owner, and the same goes for public markets. It's just a different way that you access them, and it's illiquid. And so I've identified, I think, 5 or 6 variables that can turn something that was maybe considered to be traditional and make it alternative. Illiquidity is one. Another example would be just sort of what I would call like old wine in new bottles. Something like catastrophe reinsurance. It's been around for centuries.
Well, I liked that section. I thought it was interesting.
Yeah, there's publicly traded reinsurers that have been around for 200 plus years. Like, this is not a new business. This has been a historically profitable way to make money in a very uncorrelated way to financial markets. What's new or novel about it, or alternative about it, is that it's now packaged in ways that investors can allocate to it through things like mutual funds or interval funds, which that didn't exist 10, 15 years ago.
What's interesting is that it used to be inaccessible was sexy, right, in terms of in alternative investments. Now we want them democratized, simple, and easy to access, which is all net positive for the industry. So no complaints there. And
I think like another, we don't have to get into the pros and cons on something like Bitcoin, but I think, again, like if you draw a parallel to that versus gold, as like this idea of like, if you're trying to translate it for an end client that maybe owns gold or is more familiar with gold, you've got just a non-sovereign store of value monetary asset, but just, again, a different way to get that with different features than something like gold. And so I think what the challenging part with alternatives is that it's a very vague word, and it's there less to tell you about what something is and more about what something isn't. And it's also, a moving target. Things that maybe were considered alternative 10, 15, 20 years ago, maybe less so today. And it's also in the eye of the beholder. We just mentioned Bitcoin. Like, if you ask a 20-year-old investor or someone in their early mid-20s, it's pretty common for them to have like a meaningful allocation to crypto. They don't view it as an alternative. It's just like something they buy. Like, it's like stocks to them. It's not, I don't want to paint with too broad of a brush, but that's kind of what you see in some of these like surveys, et cetera. So depending on who you're talking to, they might have a wildly different version of what's an alternative or not. And then, like, there's some examples on of things like emerging markets or high yield bonds, publicly traded REITs that again, kind of, in their earlier days were not exactly the things that you would find in the average investor's portfolio, but as they got better understood and had greater fund creation and flows and et cetera, those are pretty common line items in many model portfolios built by advisors these days. And so those things that were kind of deemed alternative are pretty commonplace in more traditional investments today. So
Sure.
I think it's a good thing to do is really, and we could do a better job of this too, is trying to get away from that word alternative more and more. Like, it's still going to exist. We're not going to get around it completely, but just maybe breaking it down into more component parts as opposed to lumping them all together. Yeah. Because at the end of the day, like real estate and crypto and private equity and insurance-linked securities, like these have nothing to do with each other, but they all get lumped together.
Yep. I won't ask you to explain FTX, the fire festival literally playing out in financial markets. One of my favorite parts, maybe the part that I remember most, there was one of the epigraphs had mentioned infrastructure being more important than architecture, and I had never heard of the source of that. I forget who it was now, but it just makes me think of the idea of like structural alpha and just building the base. So when we think of infrastructure being more important than architecture, and I think you were referencing infrastructure as more the actual asset class.
Right.
I'm thinking of it going back to the basics of asset allocation to just say building a base, where the right environment. And if you think about a city, yes, cities are well known for their architecture, but it's the infrastructure that's sort of the behind the scenes plumbing, if you will, that makes it really tick. And that's where I come back to that creativity in asset allocation, portfolio construction, and so forth. And it just makes me think that using alternatives to manufacture alpha, in that being more around structural alpha than, say, outperformance, right? To say using asset classes creatively to optimize a portfolio, to shield from losses, capture a decent level of return. But really, it's that structural alpha that, like, you don't have to time the market. You don't have to find the right bonds, stocks, asset classes, what's correlated, what's uncorrelated. It can really quickly become mathematical acrobatics, right, in our space. But sometimes just choosing the right structure, the right vehicle, and the way to implement these things is very important. How do you advise clients on the implementation component to just say, hey, we don't have to do all kinds of fancy, sexy things, and we try to do those things, but sometimes just getting the basics is good enough to manufacture more favorable outcomes?
Yeah. I would use an example of something like managed futures, where if you look at just at the surface level, especially up until this year in the recent decade prior, like that was an asset class that garnered a lot of interest and attention following the financial crisis because it was one of the few things that was positive.
Yep.
And then it had a struggling decade. So I think if you were to analyze the sort of returns over potentially 10-year period of managed futures as a whole, people said, why is this investment worth it? It's had decent sized drawdowns and it's pretty meager returns, and it comes with a lot of volatility. Like on the surface, it might not seem like something that is a worthy addition to your portfolio.
Yeah.
But I think it's about stepping back and understanding that the when of diversification is very important. And when you look at something like managed futures historically, it's done its best when the rest of your portfolio is at its worst. Those tend to be, and it's tended to be a very reliable diversifier exactly when you want diversification the most. There's a lot of other types of investments that are diversifying most of the times, but when the world's on fire, and they result in spiked correlations and don't offer that same level of protection and defense. And so I think that's something to think about when building portfolios, is really just understanding the sort of when and the why. Like why should something like managed futures do particularly well in a prolonged bear market, and kind of understanding the role of trends and when trends can become pronounced across different asset classes and almost strengthen upon themselves. And so I think we're seeing that this year. It's one of the better performing things asset classes out there. I think it's got a slightly positive long-term return expectation, but nothing you would get too excited about in absolute terms. But when you think about the benefit it provides your overall portfolio to be able to act as a true source of diversification when you've got really stressed markets and traditional assets, that's an important feature to look for in an alternative, not just how it does in normal times, but how it does in extreme periods as well. Yeah. And actually can be something that actually benefits from volatility.
Yeah. Well, that's something that's near and dear to Halo, hence the name Halo, is to say, how do you add some level of, I don't want to say insurance protection, because our friends in compliance freak out no matter how I describe it, but metaphorically, some level of buffer or cushion protection where asset allocation is just hard to do with traditional stocks and bonds. And that's why we use what we call protective investments, right? Is all about, like, is there something you could build in structurally that could sort of like take the wheel, if you will, in the event things are moving sideways on you. So it's certainly something that we're near and dear to. All right, this is entirely unscripted. For those, Phil didn't know the questions. I mean, he knew we were going to talk about the book, but he didn't know the questions. So we like to try and keep it a little bit unscripted, so it's more genuine and authentic. So you're doing a great job. But I got one for you. Who's your favorite author? Like financial, or it doesn't even have to be financial. Is there a particular author or line of thinking that just is best frames you, right? Like that just analogous, that lines up with your thinking. Is there anyone out there?
I would say the book or a couple of books now that have been the most impactful on my thinking as an investor and as an allocator have been from one of Cliff's colleagues at AQR, Antti Ilmanen.
Sure.
And particularly his first book called Expected Returns, which was just a very eye-opening book for me when it comes to thinking outside of traditional constructs and looking at diversification from multiple lenses. So it's a very dense book. It's probably, I think it's 500 some odd pages. It's not what I would call beat trading. I think Antti's a very good writer, but it's also very technical and so I think I appreciate what he does, not necessarily for the writing quality necessarily, but more the thinking behind it. And just the academic rigor that comes with it, and all the supporting, data as well. And he has a newer book out as well, Investing Amid Lower Expected Returns, which is a little bit more digestible than the first book, and kind of an update to a lot of it. So that's had a profound impact on me when I think about maybe less dense, less technical writing. And I think one of the earlier books I read in the industry was The Most Important Thing by Howard Marks of Oaktree.
Oh, yeah.
And that was, I thought, just he's a phenomenal writer. Always like to read his investment memos, and so there's that. And then more, I guess, for the if it's my brother or a friend that just wants like a basic like personal finance type book that they can understand while being like an investment novice to a degree. Morgan Housel is, I think, pound for pound the greatest investment writer of our generation, and it's no surprise that his book, The Psychology of Money, has been just the wild success that it has been, and I recommend that pretty blindly to I think most recently was like a younger cousin of mine who just graduated college. I'm like, you got to read this. Another recent one was Nick Majuli. He writes of Dollars and Data blog. He has a new book called Just Keep Buying. Again, this is exactly what I would want to hand a younger, earlier investor in their 20s that would help them, I think, avoid some of the pitfalls and mistakes that people fall into early in their investing lifetime, where they sometimes have to learn lessons the hard way and kind of pay that market tuition. Yep. I think reading people like Nick or like Morgan or even folks like Michael Batnick and others, I think can do a great job of getting investors on a better foundation earlier on in their paths versus having to kind of learn the hard way through the inevitable boom and bust cycles that we see.
Yeah. Josh Wolf, you mentioned the book to another prolific. Morgan Housel. I'm just every Saturday morning I wake up, I'm just like how every week he comes up with such great ideas. He's got to have a. I'm convinced he has a staff of writers for him, because like how does one find time to come up with such clever things every week? And I'm being facetious there. I'm sure it's genuine.
Morgan's a friend, so I have a joke with him because we both published through Harriman House.
Yep.
And so I always like to say we collectively sold over 2 million copies of books for Harriman House.
Oh, nice. Well, let's
Except he individually sold more than 2 million copies. I'm a small fraction of that. So.
Hey, at least you're contributing. Well, in all seriousness, we think that finance it's a Wall Street dog eat dog, but really I mean it's finance has done a huge job of elevating the quality of life in the world today, capitalism and all of these good things. And so it's important, financial literacy and reading and books on financial topics. I mean, it's huge.
Well, not even just books. I love sharing with, like, I get reached out to periodically from, like, because I've got like a presence on Twitter and like my blog and stuff. And like, I'll get regular emails of just like either people that follow me or maybe it's people I went to Indiana, like maybe, kids that are students in finance at my alma mater, and like, hey, how do I get started? Like, what should I be reading? What should I be doing? And I think people just assume like, oh, well, you got to be reading, the Wall Street Journal and the Financial Times, like page to page every day. And that's all. It's important to know, have a pulse on what's going on in the world, and I think there's good stuff in there to learn about, just the day to day of markets. But you should be reading well beyond that. And it's not even just reading. I think like what I often recommend to like younger investors is there's so many great podcasts out there. Like we're on another
like Stay Invested podcast.
Yeah, like the Stay Invested podcast, and it's like that stuff like didn't exist in the form it does today. When I was coming out of college, and I wish it was, because like you listen to like. Patrick O'Shaughnessy is a great example in what he's doing with his Invest Like the Best podcast. Like, there's just such a wealth of amazing, free to access like information and knowledge out there that as long as you're just willing to be proactive and kind of go down rabbit holes, like it can be as valuable, if not more, than what you'll learn in the textbooks and your college coursework and stuff like that. So I think it's just a wonderful world we live in from that regard, where if you just find the right people to follow on Twitter and the right blogs to read and the right podcasts to listen to, et cetera, you're well on your way to having a successful investing experience.
Yeah, I'm fortunate enough to teach at several universities here locally around Chicago, like Lewis and North Central, you might be familiar with, and students ask me all the time, oh, I can get a Wall Street Journal's, Barron's, like you said. This is great for like news, but like I always read philosophy, history, really to pull the ideas from the subject.
Yeah, it's important to make sure that like the majority of what you're reading isn't like stuff that is going to be irrelevant in a week or a month or a year.
Tomorrow.
That's just sort of like kind of fleeting, passing in the moment. Like you want to, read as much, if not more, things that are a bit more timeless in nature. I think that's going to ultimately have a better marginal impact on your behavior.
Yep, totally. Yeah. Well, I at least I got the first edition of the Allocator's Edge because I'm confident. Like I don't know what Seth Klarman's first edition goes for his book now, but it's into the thousands. So this will be a collector's item, hopefully one day. I think you're ahead of the curve time-wise, especially when you must have started it. And everywhere I look now, everybody's talking alternatives, right? So last question for you though, Phil, and this is a tough one. I'm gonna to help your thinking and favorite for enjoyment. Your two financial movies. One, what's most entertaining, right? And which one might be the most educational, if you will. Favorite cinematic movies, finance topic related.
Oh, man.
See, I knew I'd stump you with one.
Finance topic related. I thought The Big Short was really well done, and I think maybe one of the more underrated financial movies was Margin Call.
Yeah, I was going to say Margin Call.
That was a really great. I don't think it ever got as much due, but it was a really, really good movie, and I think there was just so many lessons learned from the crisis period back then. That was, those were my formative years in the business, and I just remember feeling like a deer in headlights at the time because I didn't know anything about anything. I was very wet behind the ears, just trying to get started in the industry, and it felt like the world was like crumbling down around me, and I didn't know what to make of it. So I think just having, after the fact, these like books and movies and things like that came out to help you kind of better understand what you experienced when you didn't know, exactly what was going on, because I was still kind of so young and inexperienced at that time. So
Well, I thought the boardroom scene with Jeremy Irons, I believe it is, the risk management margin call was fantastic. So I know, like you said, a lot of them get a lot of the.
And we'll see. We'll see how the eventual FTX.
Yeah, I'm sure they're working on the
movie
screenplay.
Well,
now.
I know Lewis was already following him around to do a book. And,
really?
Yeah.
All
so
right, great.
and so I'm sure that's got a different ending now,
Yeah.
but maybe that'll be 11 chapters long.
It's interesting. Well, I'm sure it's like gold for Michael Lewis already. So
Yeah.
a plot twist already.
Yeah, but it's amazing to watch the world of crypto learn all the same lessons of traditional finance.
Yeah, exactly. Well, what goes up must come down, I guess. And a reversion to the mean. I mean, classic financial topic. Well, Phil, we really thank you for your time today. We're thankful for you to come in, have this opportunity to speak with you, and we look forward to doing it again.
Yeah, no, it's been a lot of fun. Thanks for having me.